Ladies and gentlemen, good day and welcome to KOLTE PATIL Developers Q2 FY21 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shiv Matu from CDR India. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone, and thank you for joining us on the Q2 and H1 FY21 results conference call of KOLTE PATIL Developers Limited. We have with us today Gopal Sarda, Group CEO, and Vikram Rajput, Head Investor Relations and Corporate Finance. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available on the Q2 and H1 FY21 results presentation that has been sent to you earlier. I would now like to invite Mr. Gopal Sarda to begin the proceedings of this call.
Good evening, everyone. I warmly welcome you all today and thank you for taking out time to join us to discuss the operating and financial performance of our company for the quarter and half year ended 30th September 2020. I hope all of you, your colleagues and families are keeping safe and healthy in this trying period over the last few months. As we collectively fight against the continuing overhand of the coronavirus pandemic, we are glad to report a marked sequential improvement in our Q2 financial year 21 performance across all our key operational parameters. Our sales traction for the quarter showed an improvement over the last quarter, both in terms of area as well as the value. In Q2, sales volume was at 0.35 million square feet, an increase of 12% over Q1, and sales value grew 18% at Rs 194 crore QOQ. Buyer interest is getting more widespread, driven by increasing site visits and virtual interactions. The October sales numbers showed an encouraging improvement, registering close to our pre-COVID level. Going ahead, we expect the current momentum to sustain based on sustenance sales in existing projects and a series of launches that are in the pipeline for the next few quarters spread across Pune and Mumbai. Therefore, sales are expected to be substantially stronger than H1 during the second half of the fiscal. KOLTE PATIL has a positive track record of efficient and timely project execution through the years. This has enabled us to gain the support and confidence of home buyers who entrust us with their life's capital. Over the years, we have measured up to their trust and expectations to build a strong reputation for the KOLTE PATIL brand. Moving forward with the purpose, we have picked up pace of construction activities once again in the second quarter. We have managed to mobilize 80% of the labor force at most of our sites, and at Life Republic, the mobilization of resources is greater than the pre-COVID levels. Labor force strength at Life Republic significantly improved from approximately 1,200 pre-COVID to 1,400 plus presently. We plan to deliver 760 units amounting to 0.85 million square feet in H2 financial year 21. Pickup in sales and execution had a beneficial impact on collections. Collections in Q2 financial year 21 came in at Rs 201 crore, which is nearly double the Q1 level and better than what we had envisaged earlier. Further, we are glad to share that the month of October has seen us reach pre-COVID levels of business and execution, with collections crossing Rs 110 crore. We are expecting to sustain this momentum and report strong collections for the remainder of the year. H2 financial year 21 will witness strong collections and construction activity at Life Republic. Further, collection to also benefit from Bengaluru projects, Exente and Raga. The combination of low debt, improved collection, and operational efficiency will allow us to deliver healthy free cash flows even in this very difficult year. Our Mumbai story continues to shape well, and we have a solid portfolio of society redevelopment projects in prime suburban locations. We have already achieved key milestones including IOD, 3 NOC and MOF approvals for Om Shri Gokul, Sagar Vaibhav and Hari Ratan societies, and CC for Om Shri Gokul. Further, vacation notices have been served to the residents and tenants of Sagar Vaibhav and Hari Ratan societies. Post-vacation, we will be obtaining CC approvals for these societies. We remain on track to start execution at these 3 projects as the new calendar year starts. In aggregate, these projects have a top-line potential of over approximately 1100 crore. Also, we have another 4 million square feet coming up for launch across Pune and Bangalore with an aggregate top-line potential of over rupees 3050 crore. Overall, we are happy with the progress made with respect to business development since the lockdown started. We are seeing owners of both land as well as capital gravitating to developers with strong execution skills and deep process orientation. In this situation, we are centered on building a sustainable series of projects in the 3 addressable markets, both in terms of area and value. Subsequent announcement will see capital light addition to our portfolio before the close of financial year 21. Our balance sheet remains strong and debt to equity was at 0.38 times equity as on 30th September 2020. Going forward, we see the structural demand theme of the sector developing on the back of several drivers. A combination of lowest inflation-adjusted home prices in many years, sharp decline in interest rates and stamp duty cuts have considerably improved affordability and overall consumer sentiment. Branded developers with stronger balance sheet and execution history like KOLTE PATIL have consistently enjoyed buyers' confidence, and we expect our holistic 360-degree approach to allow market share gains and generate significant long-term value for stakeholders. On that note, I conclude my opening remarks. Would like to now ask the moderator to open the line for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohit Balakrishnan from Riddhi Capital. Please go ahead.
Yeah, hi. Hi, sir. Am I audible?
Yes.
Yeah, hi. Thank you for the opportunity, sir. And I hope you're doing well.
Okay, Rohit, now you're not audible. Can you be a bit loud, please? And closer to the speakerphone. Thank you.
Okay, so I have a couple of questions. So, sir, can you share what is the ready-to-move inventory that we have and what is the contribution from Bombay and other geographies?
So as on today, we have approximately 230 crore RTMI inventory, which is lying at Jai Vijay, Raga project, and we have some retail shops at Western Avenue project. And as far as the overall contribution is concerned, I think we have a detailed slide on the investor list presentation wherein we have given a breakup of 0.35 million square feet of pre-sales and the collections as well.
Okay, no, I was just asking of this ready-to-move inventory, how much is from Bombay and how much is from Raga?
Okay, so if you want further breakup, then I think Mumbai we have close to 80 crore approximately, and balance would be at so 80 Mumbai, 50 around Western Avenue, and the balance 100 crore at Raga. So 50, 80 and 100.
Okay, got it. The second question was, sir, in terms of your future pipeline, you alluded to about 1,100 crores in Bombay and about 3,000 crores odd in Pune and Bangalore that you expect. So these launches, broadly, in how many quarters do you expect? Like how much do you expect these projects to be launched in FY21 and how much in beyond FY21?
Sure. So I think this financial year, before March 21, Mumbai all projects will go for the launch, which is approximately 1100 crore. And then based out of Pune, there will be 2 projects. One, R10 sector based out of Life Republic, which is 1.42 million square feet. And there is another small project at Wagoli, which is 0.25 million square feet. So these are the 5 launches, which will definitely be covered under the current financial year. And the balance launches will be span out in H1 and H2 in financial year 22.
Okay, but all of this will happen in the next 5-6 quarters.
Yes, for sure.
Got it. And sir, just one more question. I mean, our long-term guidance is sort of to do about 4 to 5 million square feet over the next 3 to 5 years. So of that, if my understanding is correct, you expect about 3.5 million from Pune and about 500,000 from Bombay and the rest from Bangalore. So I just please correct me if this is not if this is incorrect. But if this is correct, so I just wanted to understand right now our throughput from Bangalore is around only 250,000 square feet a year, if my numbers are right. So a ramp up of from 2.5 lakhs to about 1 million is a very steep ramp up. So just wanted to understand what is your thinking specific to Bangalore market, and are we having any launch there or any DM that we are doing to sort of get business development to add to our portfolio there?
Sure. I think very good question. So numbers more or less are right. I think I have guided on that parameter only 3.5 million for Pune. Between 0.5 to 0.7 I said about Mumbai, and then the balance million square feet at Bangalore. So I think we are pretty much on track as far as the Pune and Mumbai portfolio is concerned, because Mumbai we have these planned launches, plus we have the 5 forthcoming projects at various locations of Mumbai. And Pune, I think since lockdown till date, we have done a phenomenal job in BD. I think it's all about announcing the deals at a right stage. We have ensured that the balance sheet remain light, and approximately 3 to 4 million square feet of business development announcement will happen before March 21. So I think I'm pretty much happy with the business development performance for Pune, because all those are very, very asset light and in a very unique structure. As far as the Bangalore is concerned, I think we are lagging behind. We have approximately some 0.7 million square feet of inventory, but the Bangalore plan is basically a long-term plan. So when I said about 1 million square feet, it will happen over a period of 2 to 3 years. So I am not expecting Bangalore to contribute significantly by March 22 or probably H1 23. It may take to March 24 level, but definitely on a year-on-year basis, we'll show some progress. So like if you see earlier days, we used to sell only sort of 80k square feet based out of Bangalore, but in last 2 years we have revamped from 80k to 2.5 lakh, so which is almost like a 3x jump. So likewise, it's all about the shortage of projects. So at the moment we have more projects in Bangalore market, I think we'll be able to deliver more sales, because from the same city, if we can do 3x sort of a pre-sale growth as far as Bangalore is concerned, we are at some sort of a discussions with some of the landowners under DM and under some sort of profit sharing, or some are outright. But I think Bangalore market is a bit of tedious market from a legal perspective, and we haven't done much of the acquisitions in last 7-8 years. So it will take some time to revive there, but I am confident that over a period of next 3 years, we will be able to achieve a million square feet number. It's all about acquiring more projects and giving launches at the right time. So probably Pune and Mumbai, we are pretty much on track, and I think March 22 would be a phenomenal year for the company, wherein we will be delivering a robust sort of performance across parameters, maybe top line, collections, bottom line. So I'm expecting the next financial year, we should be in a position to generate approximately 550 to 600 crore as a free cash flows or operating free cash flows for the company. And Mumbai and Pune will contribute significantly over there. So hopefully March 22 and then followed by March 23, I think in the next 2 years, we will see the sharp growth in terms of all parameters, and we will be able to achieve our number in next 24 to 36 months times, as far as the pre-sales are concerned.
Got it. So just as a follow-up on this, so we've been doing, I'm excluding this year, last 4 years we've been around 2.5 million square feet, give or take. This year obviously one should not take in, but can this number then substantially go up by 30-40% in terms of pre-sales? Would that be a fair assumption, sir, in FY22?
So if we are going to compare from 2.5 million as a base of March 20, and if you want to see March 22, I think comfortably we should be able to generate more than 35 to 40% sort of a pre-sale growth. Because there is a good pipeline at Mumbai, there are good launches at Pune, and also there are the business development which we are expecting by March 21 will also come for launches in H2 financial year 22. So we can definitely achieve anything around 3.5 to 3.7 sort of pre-sale number by March 22.
That is very heartening to hear, sir. Thank you. Just one last question, sir. Just on this Pune, the plan that we have, the launches this year. You said you said two projects. Both are commercial or?
No. I'll answer. So basically, I said Life Republic, based on Life Republic R10, so which is a mixed-use development. So we have approximately 80K as a retail portion there, and then the balance 13.5 lakh is a residential portfolio, and the one project which I said at Wagholi, which is pure residential. So I think the commercial launch is yet to happen. That will go in the next financial year.
Understood. Thank you very much, sir. If I have more questions, I'll join back. Thanks a lot.
Thank you. The next question is from the line of Biplab Devrama from Antique Stock Broking. Please go ahead.
Sir, good evening. It's heartening to see the optimism. Sir, I have one question. So you gave the cash flow number of FY22. So for FY21, what would be the expected cash flow that we expect from KOLTE Patil?
Sure. So if you see in Q1, we have done a collection of 105 crore, and in Q2, we have achieved 201. So as of H1, we are standing somewhere around 305 or 310 crore. But I think we have seen a sharp uptick in terms of collection in the month of October. October, we have surpassed 110 crore, and the momentum will be continued because now the labors are back on site. Life Republic is at 110% sort of execution, and we have good sold receivables lying at Life Republic and other projects. So I'm expecting 100 crore plus run rate will be continued till March 21, and we are expecting for the financial year 21 we should be able to collect 875 crore as a collection for the year, out of which 400 crores will go towards the construction. Then we have approximately 200 crore as sales, marketing, admin, employee and finance cost, and we expect 75-80 crore sort of tax outlay in the form of direct indirect tax. And still, in spite of a very difficult year, by March 21 we should be operating cash flow positive by 200 crores.
So, sir, is there any chance of, because although net debt has increased marginally, is there any chance of net debt going down? I mean, I know it's a comfortable level. Just wanted to understand. Net debt, is there any chance of going down?
No, I don't think the net debt will go down. I think probably the debt level would remain same. The reason being we have to clear the last tranche of ICICI Venture. There are some sort of initial investment by way of deposits or some sort of outlay on the BD front. And then you know that during launch you have to invest in TDR, paid FSN and premiums. So I assume or I believe that by March 21 there will not be a sharp reduction in the debt. It will be more or less similar to March 20 levels.
Okay, so good to know about the cash flow level. Sir, another question is on the last 2 quarters. Is there any, I mean, there are trends that we are hearing, but is there any significant trend that says that ready to move in inventories are preferred, or in mid-income segments are selling more? Is there any trend that we can see in the last 2 quarters that you can see in your Pune projects?
So I think there is a demand for all the products, and it's all about the right product mix. So what we have witnessed at our portfolio is that all are affordable MIG 24K shops, retail, everywhere there is a good demand which is coming back. I think the only substantial change what we have observed is that the demand to the 3 BHK homes is going up, and to some extent the same has been adjusted from 1 and 2 BHK. So if you see our H1 presentation, which we have H1 presentation of the pre-sales which we have captured in investor relationship presentation, I think the 3 BHK demand has moved by 6 to 8%, and which has got adjusted from 1 and 2 BHK. And as far as the higher segment, to our surprise, I think we haven't seen any kind of deduction in terms of pre-sales. So a project like Opula, Stargaze, and other high-end projects. So I think all those projects have contributed to a pre-COVID level. So we believe that there is a demand for all products. It's all about the right product mix, and one has to balance the portfolio between affordable to mid-income as well as the 24K. So we maintain currently 80% of our portfolio into affordable to mid-income, and 20% is into a luxury segment, and I think which is panning out well for us, and the demand is coming across spectrum.
Okay, sir. If I may squeeze in one more question, is on your Mumbai launches, I understand that in Q3 you'll be launching, everything goes well, you'll be launching one of the projects. First of all, I wanted to understand what would be ticket size. You have in the previous con call told us about the rate, selling rate. We just want the ticket size of including everything, what would be the typical ticket size? And do you have any apprehension about say the sales velocity on launch? Because we have been seeing, that's what we have been hearing, that ready to move in inventories are selling, and in Mumbai below 2 crore inventories are selling at a good sales velocity with a reputed developer. So regarding reputation, there is no question about KOLTE PATIL. But about the ticket size and about the new product launch in the western suburb. So what is your take about it?
Yeah, I think I'll answer your previous question first, which has been halfly answered, and then I'll cover this one. So I think you are asking about the flavor of the market, whether there is an inclination towards RTMI or under construction or nearing possession. Yeah. I think what we have seen is that there is a demand across. No doubt, RTMI is a preferred inventory for the buyers, but if you see the branded players, I think they are selling all inventory because there the trust factor is there. So customer preferably wants RTMI inventory with B or C developers. When it comes on the A group or a branded developer like us, I think they trust our stages. They prefer under construction, launch or RTMI all inventories, and that's the reason in October we have seen a sharp sort of recovery in our pre-sale number. So there is a demand across spectrum. Up to sort of a 3 crore inventory, I see this is the more or less trend, but above, like in the luxury segment, if you'll ask me, about 10, 12 or 15 crore onward inventory, maybe you are right in terms of RTMI is the preference. But I think this segment up to 3 crore, the inventory is moving across stages. As far as your second question is concerned from the Mumbai portfolio, so we have very well positioned. I have said on many of my calls that our focus 1, 2 and 3 BHK inventory and up to a 3 crore bracket. So if you see a Sagar Vaibhav project, we have 1 and 2 BHK product there, which is in the range of 95 to 1 crore 1 BHK and 120 to 130 lakhs as a 2 BHK product. So that is obviously from a Mumbai market, it's like more into a budget homes. When it comes to Hari Ratan, I think it's also not touching beyond 2.8 to 2.9 crore. So we have 2 and 3 BHK product there ranging from 2.4 to 2.9 crores. So I think in Hari Ratan also on the residential front, we are comfortably placed. And as far as the retail portion, both locations, Om Shri Gokul as well as Hari Ratan, the retail shops are in the range of 3 to 4 crores. And there is a flexibility. If some buyer wants to combine the shops, then we can club it. Otherwise, we have the individual units also in the range of 3 to 4 crores. And like Om Shri Gokul also, again, it's more or less similar to 1.1 to 1.75 crore, 1 and 2 BHK products. So all our products are at a very strategic location, nicely placed in terms of the ticket size, in terms of the products. And we are confident and hopeful that we should be able to upload this inventory in next 30 to 36 months time span.
Okay, thank you, sir. I have few questions. I will come back in the queue, sir. Thank you, sir.
Thank you. The next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Gopal. Gopal, my question was more on the pre-sales. So I was expecting a slightly better performance from KOLTE Patil. So like what other Mumbai developers have been able to do this quarter, they have, in fact, some of them have actually recovered the entire pre-COVID sales. But we have somehow lagged behind. So what makes me look at the numbers is that you have not been able to gain market share. So any reason why the numbers are not looking up?
So I think we have to bifurcate the market share in both the markets, Pune and Mumbai. So if you see Mumbai, I think we have sold some good 5 to 7 units at Jai Vijay project. And as far as the Pune is concerned, we have a limited inventory, Parikshit. If you see, there is hardly 3.8 to 4 million square feet of inventory which is lying, and it's been last 18 months to 20 months. This is more of a sustenance inventory, and there is less of the choice. So probably the moment we'll open the new launches and probably the moment we'll open the new inventory, so the choices will go to the next level, and I think the pre-sales will reach to the next level, and then you will be seeing that the KOLTE Patil market share is coming back. So currently for the next last 2 quarters and probably one more quarter, we will be struggling in terms of larger pre-sales, but the moment we will be opening the fresh inventory and the launches will happen, the pre-sale number goes to the next level, and then we can regain the market share. So this is sort of a little of sustenance phase for us, and that is stopping us to gain larger market share.
This year, I mean, you said October is now back to the pre-COVID level. So will third quarter be more like a normal quarter, or you said that still there will be some struggle and then fourth quarter may be a normal quarter?
So I am basically expecting R10 launch by end of November or first or second week of December. So if the launch actually happens as per the stipulated timeline, then probably Q3 will be obviously normal to a pre-COVID level, or probably it's like a 80-90% of pre-COVID level, and Q4 would be a bumper year wherein we will catch up our numbers. So I think this R10 launch is a big event for us, and we have a good base on that.
We'll end the year somewhere around 1.8 million square feet, about that range.
1.42 million at R10 and then approximately 0.25 million at Wagholi.
No, I'm saying pre-sales volume. So will we end the year at about 1.8 million square feet this year, total pre-sales for the year?
Yeah, we should be able to touch that number comfortably.
Okay, and if some Bombay launches happen, then value-wise we'll be still higher. So in terms of value-wise, we'll be still maybe we should be able to match last year's number.
Yeah. So probably I feel that from Q3 onwards, I think so far we have been talking about 1 million square feet, and in terms of deliveries, I think going ahead as the Mumbai contribution will start flowing into the system, we have to talk on both parameters, value as well as million square feet. So as I was saying at the opening remarks and couple of questions which I have answered before you, I think I am expecting probably H2 onwards or probably Q3 onwards and next financial year on the value front, there would be a significant jump. Maybe on the million square feet front, we may see that March 22 will be closing around 3.5 million. But on the value front, I think we should be able to surpass by 45% of our March 20 numbers.
Coming to collections, I mean, the intensity of collections is still not normalized. So are we able to? So what's the constraint here? I mean, are the banks not disbursing the EMI still, or there have been cancellations? So how do we look at the collections number, because it looks to be off the cliff?
So Parikshit, if you see, I think on the collections front, I think Q1 we all know it was a complete lockdown period and banks were not ready, and I have answered in my last IR call. I think April and May it was a steep dip. We were at just 29.
I'm talking about Q2. This Q2.
Yeah. So I'm coming to Q2 as well. On the Q2 front also, if you see the construction momentum started mid-August. So the first 1.5 months, like July and 15 till 15th of August, there was not much progress. This was more or less like a similar environment of lockdown, because July month, Pune was into a lockdown for a good 15 to 20 days. And then mid-August, the labors have started resuming. So the actual pace has started in the month of September, and that you see that in the month of October, we have already seen that we have collected 120 odd crores. So I think October onwards, you will see a sharp uptick in collections, and going forward, we will be able to continuously collect more than 100 plus crores. And that's the reason I said about if you deduct 850 crore minus the 305 crore we have collected so far. So I am talking about a 550 crore number in next 6 months, which is more or less like 100 crore run rate. So I think we will be able to catch up in H2, because the construction progress has started to almost a pre-COVID level, and now everything is moving. The pre-sales, the new pre-sales is also coming back, and as the RTMI inventory will flow, I think the collection can further uptake. So projects like Jai Vijay, Raga, and some shops which are at Western Avenue, the moment we will be able to upload, I think the collection can go to the next level. But for sure, it will Q3 and Q4 will more or less in line with the pre-COVID numbers.
Okay. So that is the reason I think why the POCM loss is also coming, because the construction has not really picked up and there is under absorption of overheads, right?
Yes. So I think on the POCM loss also there were two reasons. One, what you said is also right. The collection, the construction pace has not picked up and lower revenue recognition because of that. And one more reason is based out of the maximum revenue has come from R16 sector based on Life Republic and Western Avenue project of Pune, ENF Tower. So Western Avenue project, we all know that this is a low margin project because of the high land cost. And as far as R16 sector based on Life Republic, this is at a very extended end of the township, wherein the average selling price is at 4,700 vis-a-vis the rest of the township we are selling at 5,000 to 5,200. So probably on that front also, these are all low margin projects and lesser construction execution. But Q3 and Q4 we will again revamp and it will go into the pre-COVID levels of P&L.
So I was expecting that with stamp duty cut there could be some movement in RTMI. So what's your view on that? So we have not really seen any big pickup there.
I think velocity is a function of three things. It's all about your freebies, discounts and payment plans. So currently, I think as far as the Raga, Jai Vijay inventory, we have not basically given some sort of a deferred or long payment plans or some sort of a steep discounts. So probably we feel that I think we are maintaining a moderate velocity, and this stamp duty obviously to some extent a city like Mumbai, probably 3% value is not that attractive, but as far as the Pune and other locations are concerned, yes, there is a sharp uptick. But overall, I think along with stamp duty, one has to also balance with the freebies, discount and payment plans. I think that's what the flavor of the market, and that's what gives you the next level of velocity. So we are, while maintaining the financial parameters and decent velocity, we are taking a mid view, and that's where you see the moderate sales compared to the exorbitant sales numbers which we are expecting from other players who are going extremely sort of payment plans and taking those hits on the P&L.
So have we offered any discount during this festive season? Are we offering any promotions or activation? Are we doing anything for the festive season?
So as far as the overall portfolio is concerned, I think more or less our APR are similar to pre-COVID levels, but approximately 50 to 80 rupees per square feet either in the form of freebies or some sort of spot discounts is what we are not letting go any checks. So I think that's the flexibility which we are encashing at Pune and Bangalore projects. And as far as Jai Vijay is concerned, similarly 2-3% sort of discounts for the spot closures, and to satisfy the customers is what we are doing across portfolio, but not substantial reduction. If you compare the pre-COVID sort of APR vis-a-vis during Q2 and Q1, you will not see more than 100 rupees sort of a per square feet fluctuation in the prices.
Okay, Gopal, thank you and best wishes and happy Diwali to you.
Thank you, Parikshit. Same to you.
Thank you. The next question is from the line of Himanshu Upadhyay from PGIM Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon, Gopal.
Good afternoon,
First few questions on Mumbai, the new projects or we are launching. See, currently we are working under KOLTE Patil brand only, but some of the projects which we have a good location. So something like Hari Ratan, which is on Link Road in Goregaon, or again in, I would say, south side. When do we think we would be mature enough, or the brand would be acceptable that we can have a more premium or a luxury project, or what would be the thought process? So something like when we are having car and some of the locations which are good, would you like to take them at a more premium end, because at the end the higher profitability will be in those projects or those type of products. So when do you think we can reach that level, or how would be your thought process? Can you just to give your thoughts?
Sure. So as far as the brand recognition and price premium is concerned, I think we have demonstrated that if you compare our Jai Vijay project vis-a-vis the rest of the projects in the vicinity, we are selling 15% premium. And as far as the Linking Road project which we have delivered, there also we have done a good sales of 55,000 rupees per square feet on carpet. And adjacent to our line projects, other developers were also selling at 47 to 50,000. I think I am not worried on the price premium, because the brand recognition in the Mumbai market is it's still far better than our expectations, because a project like Life Republic, we have some 800, 900 odd customers from Mumbai market. All our private equity bankers and our large business associates based out of Mumbai. And we have a good relationship since last 1 decade in the Mumbai portfolio. It's all about, we were not opening new projects. I believe that we would be commanding the prices or price premium equivalent to the reputed brands in particular market. Having said that, yes, we are not going into a super luxury sort of product development at Hari Ratan, Om Shri Gokul or Sagar Vaibhav. Hari Ratan would be MIG plus, while the other two projects would be in a MIG brand. And as far as a super luxury segment is concerned, we have one society acquired at Khar, 16th Road, Sukh Niwas. Those kind of products, probably there you will see a very, very high-end kind of a development we will do. And there we would be able to fetch 8 to 10 crore sort of a ticket size premium. So I think in that segment, yes, we will make some good profits. As far as the other portfolio is concerned, the current portfolio we are talking about, I think we are happy at 25 to 27% sort of EBITDA. Rather, we'll be focusing on ROC and IRR. So our Mumbai entry and our Mumbai strategy is to focus on ROC rather than EBITDA. So currently, you may see that on a 1100 crore sort of a top line, we would be in the 260 to 280 crore sort of a PBT or EBITDA margin. But on the investment front, I think we will win, because our investments are not beyond 80 to 90 crore. So on the delta front, the idea is to invest less and make more money in the form of multiple and build ROC and IRR rather than focusing too much on EBITDA and PAT. So that's where the focus is. And we are happy to have a moderate margins but larger ROC and IRR, and that's the strategy we are implementing across group, and we would love to work like a manufacturing company, a service provider, rather than running behind margins. So we want to grow with the ROC, IRR and net worth.
Okay, the second question was on these product launches, what we are doing. What can we have learnings from Jai Vijay or Jumbo Darshan? Means, can we do something which is faster sales? And because Jai Vijay, even after OC, we have some amount of inventory, okay? So in the next 3 projects or the coming 3 projects, what would be your thought process to increase the sales velocity, which will effectively increase the IRR? So can you give your some thoughts or learnings from the earlier 2 projects, what we have done in Bombay, and what we can do better in the coming projects in Mumbai?
Sure. So I think the learnings which we have captured from Jai Vijay project, I think we did the same thing as you were saying about, we were holding on the prices. We have not cut down the prices from 24, 25K, and we were expecting that at the time of RTMI, we should be able to command 26, 27. and we thought we will invest something by way of working capital for some time, and at ready possession the GST will go out and the buyer will give some premium and all. So I think that doesn't fructified well. On the contrary, after this pandemic and the GST came in between, I think the prices are more or less stable, or sometimes we have also to ensure the cash flows into the system. So I think that's where we have decided that rather than running into too much of price premium and holding inventory for the larger time and expecting premiums at OC, one should upload the inventory with the market momentum. And if need be, we can have a moderate price premium to manage the cash flows and remain asset light. So during the new 3 projects, we are implementing the same strategy. We may start with a moderate pricing and we will escalate if the velocity is in line with our expectation. Otherwise, we'll continue the momentum. We will not go behind the prices, and we'll focus more on the working capital cycles and enhance ROC and IRR. So that was a learning we have captured from Jai Vijay. As far as the other project Link Palace is concerned, I think that time we have showed the flexibility. We have sold the inventory in line with the buyer's expectation, and then were not too much of turbulence in the form of GST and all those times. So that project went smooth. We did not have to invest much in that project, and we have managed from the customer advances. So let's see how the Jai Vijay experience can be utilized for the new 3 launches, wherein we remain light on the investment and build better ROC and better returns for the organization as a whole.
Yeah, and one question on the Pune side, okay. So we have some stamp duty relaxations, okay. We have 2-3 projects which are slow, Stargaze and 3 Jewels, and I would say Ivy State. Some Ivy State is more 100% owned and premium also. Is there something we can do to speed up the velocity of these projects? Because what we have ongoing and unsold is 500,000 square feet to 1 million square feet. Generally half in these 3 projects, and the velocity remains 0.0 to 0.05. So is there something which we can clearly do in the festival season or next, or this next 2-3 months when the stamp duty is also less? Sir, any thoughts on that, and just how are you planning?
Yes, so we have already planned some good campaigns at Ivy Estate and 3 Jewels. So earlier it was more of a CLP plan, but then we have realized that to build the velocity, we have to give some payment plans. So I think it worked for 3 Jewel as a project. We are running a sort of a 10-90 scheme, like a 10% payment now and 90% at the time of possession. So that is giving us a good result. Earlier we used to sell there 10,000 square feet a month, while last 2 months it looks like a 15,000 number is already flowing into the system. So projects like 3 Jewels is giving good result under payment plan, and similar thought we have applied for Ivy Estate there. In spite of giving payment plan all, we thought we will manage the price in a manner that the stamp duty will be absorbed by us completely, and build some sort of a sales velocity. So probably you will see Q3 and Q4, there would be a sharp 25 to 30% pre-sale jump at these locations because of the campaigns and the kind of freebies and payment plans which we are providing here. So we will definitely show some sort of a velocity increase in H2 of financial year 21 at these locations.
And one last question. We have given in the presentation and stated currently also that in October we've got 110 crores of receivable, or the collections have been 110 crores. Is it majorly because of construction increase only, or you have seen better sales traction also in some of the nearing completion project, and hence the better receivables or better collection has been there? Anything you can throw color, means how would you divide between the two?
So it's a collage of all. I think first we have done some sales at Jai Vijay. Second, the construction pace has also revamped significantly. I think our team has done good job. There were a good slab has been casted, and effectively the money has been collected by the CRM team. So I think it's a team effort. Finance has infused money, collection, the construction team has casted the slabs, and CRM has efficiently collected. While to some extent, even little bit of RTMI sale, not significant, but yes, some sort of traction has started at our RTMI inventory. So a collage of all has given us these kind of numbers.
One last question, one last final question. See, what we see in asset management businesses, the prices are cheap for a period of time, okay? And again, we need a lot of raw material or land in our business also. How are you planning? Because what prices may be lower, maybe for a period of 1 year or 2 year, and then you have to use that judiciously for a period of time. So how are we trying to take benefit? And earlier we had also stated that we want to have a platform, or we were working on certain platforms for new acquisition of projects. So what are your thoughts? And especially because what we understand or what we think is the prices may be better than what they were 1 year back, and better opportunities be there. But generally they are for a period of time, let's say 2 year or 1 year. So how do you plan to maximize your capacity to grow for future?
So if I have understood your question correctly, you are talking about one on the commercial portfolio, second on the platform, and if you can just summarize the third question. I think these are the two.
So what I was saying was, see, the prices of land will remain cheap for a period of time, okay?
Okay.
It will not remain cheap for all the time, okay?
Correct.
So you have to grasp opportunities when the time is right, okay?
Correct.
And that time or the good opportunities can remain for 1 year, 2 year, or let's say maximum 3 year, okay? But then mean reversion happens, okay? So I'm saying in these next 1-2 years, or what window of opportunity may be there in the market, how do you plan to develop your business or means acquire more projects? And at one point of time, we said that when we would like to acquire land, we would also like to do platforms through which we could raise capital, so JV platforms or something like that, so that acquisition is not very heavy on us, okay? So what is the progress on that, and how are you seeing, means if let's say we want to be a 4 million square feet hitting company for every year from FY22 or 23, okay? Given 3.5 or something for FY22, but beyond that, then also we need to work from here on, okay? So how is the progress on that, and the platform what we were thinking about, where is the progress or opportunities, and how are you building? So FY22, 23 onwards. Okay.
Yeah, understood your question perfectly now. I think just to give you a background, I think I completely agree with the thoughts, like this time of pandemic and the business development opportunities on good terms will be there for next 12 to 18 months. And that's where we're encashing all those things. As far as the platform is concerned, I think that was the era we were looking for outright transaction. But when we have done sort of a good interactions with our landowners and sort of a developers, I think in this pandemic time they have showed a good flexibility, and they have realized that rather than going behind the land prices upfront or at a higher valuation, they want to be a partner with good developer like us, and happy to take the back-ended sort of cash flows, but on a higher side. So this is giving us an opportunity to remain asset light, build good profits, and basically create some sort of good ROC and IRR for the organization as a whole. So currently, the kind of business development I was talking about to the tune of 3 to 4 million, we did sort of like a revenue sharing models, 2 projects, 2 we did more on the profit sharing, and 1 project we did on a DM basis. So while doing also what we have to invest is more on the deposit front, and that is also refundable. And we create a decent margin of sort of affordable project will give us 750 to 800. A MIG project will give us some sort of 1,000-ish. So we remain light and we make our moderate profits. So currently, I think we would love to be asset light, because I think the pandemic is yet not over. And during our last interactions, I said that we will first focus to revive the business, and once the business is coming back to the normalcy, and once we see that there is a huge visibility on the cash flow front, then we go for the outright models and try to acquire some distress or some sort of a long deferred payment sort of acquisition. While on the platform front, what happens in this time, their mindset also changes. So initially, the thought process was acquiring on both fronts. So they were coming like a plain vanilla equity transaction, 30-70 sort of investment up to XIRR, sort of a pari passu, and then there are different ratios. But now also the platform guys doesn't want to take more risk both on the revenue and cost side, and they want to build more of a revenue model wherein they will take the market risk in the form of sales and collection, but the principal should be protected, and they are giving utmost flexibility in the form of payments, and they payable when able sort of structure without any guarantee, but principal protection sort of deals. So I think currently when the deals are coming on an asset light model, why to encash the platform, and by March 22, I think as I said 550 to 600 crore sort of a free cash flows we will also generate. So those kind of opportunities should come. If there are business development opportunities under outright model to the tune of 100 to 300 or 400 crore, I think that can be managed by us with our own capital. So unless and until we see that there is a significant amount we are looking for, and then we don't want to raise debt, that's the time the platform entry will come. But today we have uniquely redesigned our business acquisition strategies, and we are remaining very, very asset light and structuring the transactions in a manner wherein I think we are not in need of much of the capital. So maybe I think our human involvement, or I think human capital is what we are investing, and giving some sort of services to the landowner also to complete the balance parcel and then continue the show. So I think if we can invest more in the form of service and give better services and restrict our capital and invest human capital and create some sort of ROC and IRR for the organization, so why not to build that while maintaining the growth? So as I said that next financial year we are targeting anything beyond 3.5 million square feet. So we have a good visibility, and obviously at a very attractive valuation, and when we have a clear visibility in terms of not any kind of disturbances from this pandemic, and when the capital is not remain idle, that's the time we will start aggressively investing our capital, but we will not do any kind of speculation. If there is no clarity in terms of absolute milestones on the approval front, the external environment, so we don't want to take larger bets, as the business development deals are still flowing in an asset light model. And going ahead, I think a mix of all would be the right balance. We will neither go into a complete asset light, neither go into a full outright, and neither remain sort of a heavy debt. We will try to create our own hybrid structure wherein we will acquire 60% in the form of asset light model wherever we see that there is a fantastic sales visibility and historic track records, and on the sales front we are not taking much of the risk, and we are not doing experimenting in new locations. We have a track records, so then we don't mind going outright in a long deferred payments, and we will try to show the growth while maintaining the integrity of the balance sheet. So R would be a hybrid model, a balanced approach we will take, and we will always ensure that the balance sheet remain asset light and debt levels are more or less up to 0.5 sort of debt equity ratio. So in that model we are trying to build a growth, and the opportunities are there, and we haven't seen so far there is no success coming in. So at a right stage, whenever we see that we want to go for the next level of growth and this asset light model is stopping us for the growth, then we may design a change in BD strategy, and we may go aggressive on the outright front. But currently with this mixed approach, I think we see a good traction happening, and I think in next 4 months time we will do quite significant announcements which will be a good value creation program for all the stakeholders.
Thank you. Before we move to the next question, we would like to remind the participant, in order to ensure that the management is able to address questions from all the participants in conference, please limit a question to 2 per participant. If time permits, you may join the question queue for follow-up. The next question is from the line of Alpesh Thakkar from Motilal Oswal. Please go ahead.
Thank you for the opportunity, sir. Most of my questions have been answered. Just one question from my end, mostly on the Mumbai strategy. So can you just throw some light on the fact that we are basically targeting the redevelopment opportunities in Mumbai. So how big is that market, given overall Mumbai is a very big residential real estate market. So how big is this market, and who would be our key competitors in this space?
So as far as the redevelopment portfolio is concerned, we all know that there is a scarcity of land in Mumbai, and when it comes on the redevelopment, there are a variety of proposals. Typically, currently we are doing private society redevelopment. Even SRA is also redevelopment. Then there are 33/7. It's like a tenanted, and then there are MHADA redevelopment. So I think in private society redevelopment itself, there are 16,000 to 19,000 societies which will come over a period of next 1, 2 or how many decades, I don't know. And as far as the other portfolio towards South Mumbai is concerned, typically the tenanted redevelopment and other SRA and other models, I believe there is a huge work in the redevelopment market. I don't see there is any kind of scarcity of work. It's all about the right feasibility. Currently, there is a mixed feedback on the redevelopment front. I don't know. Most of the guys who were active 5 back, they are not active today. And what we see is that from last 1 year, we don't see any competition coming to us for any of the project, because we have demonstrated our own unique professional mechanism to deal with the societies, and we have created our performance as a forefront. So probably after Link Palace and Jai Vijay delivery and the other projects wherein we are very transparent in terms of our communication. So many societies are approaching us, but we want to enter into a strategic locations wherein there is a balanced view from the committee and PMC, and wherein we feel that this would be not a too much of time consuming job that 2-3 years we are just spending to acquire. I think if the society management as well as the PMC are in a manner to expedite and close the projects at a faster pace, in 6 to 8 months time we are evaluating those projects only, because we don't want to build a land bank. We want to show our production and execution performance to the market as a whole. And we are very confident that this segment will remain with us till the time we operate in Mumbai. While doing so, since there is some sort of a time consuming process, in spite of doing all this kind of professional approach and transparency, obviously the overall process remains tedious, because they have to always go to SGM and take necessary approval for even smaller things. So we want, for the growth purpose, at an appropriate time we will also bid the other portfolio in the form of joint venture outright, so that we are not heavily dependent on this, but this will remain like a one segment. So like for Pune, if you see, we have our presence in affordable, MIG, 24K, townships and retail, and each of our segments are contributing. Likewise, we will ensure that 50% of our Mumbai portfolio will be dependent on the redevelopment, but parallelly we'll build another 50% portfolio in different structure and different locations in a different sort of deals, maybe JV, joint venture and outright at a right valuation. So we will ensure a collage, and we will ensure that we are showing growth both ways.
That was very helpful. Just a small follow-up on that. So is there any significant difference between the IRRs that a redevelopment project has and a normal outright or the JV kind of project?
So as far as redevelopment projects are concerned, I think we are currently not measuring on a IRR front, because maybe if some projects wherein we have not invested more than 20-25 crore, and if the returns are 70-80 crores, the IRR can go to 2-digit, 3-digit also. So I think on a redevelopment front, we are going more on a ROC front, while on the outright JV, outright model only is where we are calculating on the IRR front. So I think JV's profit sharings and redevelopment, we will calculate more on ROC, and pure outright, like a complete land consideration or a deferred payment or upfront, that time we calculate on IRR, because in the JVs also, typically, as I said, in Pune also, in 10-15 crore deposit, we can manage 100 crore sort of a profitability. So probably I think it's wrong to calculate IRR and set any kind of benchmark internally for the performance parameters.
Got it. That was very helpful. Thank you. That's it from my side.
Thank you. The next question is from the line of Manoj Dua as an individual investor. Please go ahead.
Hi, Gopal. In case of redevelopment projects, are we getting more feeler from societies post-pandemic that they wanted more because of more balconies, work from home structure? Are we getting more proposal from the redevelopment, or it's too early?
So I think, Manoj, it's reverse. Nowadays, societies are showing flexibility. So in couple of societies, even we have done some sort of renegotiation, and we have taken some sort of flexibilities in upfront payments. So they were very cooperative in the pandemic time, and they have addressed all our concerns, and we are gaining sort of good returns on the back of their mind change. So there is no absolutely demand on the extra spaces, extra balconies or anything. They just want their project should start and they want the developer should not stop. And they are showing the flexibilities because some of the structures are into dilapidated stage, some of the buildings are very old. So nowadays members have or the societies have started showing flexibility, and parallelly we are getting a good sort of flexibility from the BMC also. You look at the premiums. Earlier we have to pay all premiums upfront. Now we have got some relaxations to the tune of 4 year, 5 years. So you have to pay 10% upfront, then 22.5 into 4 installments. And if the building is beyond 70 meter, then you are getting 5 years tenures. So basically 18.5% at 8.5% cost. So I think redevelopment is now spanning very helpful for us, wherein we have the BMC giving deferred payment at 8.5% and that too over a period of 4 to 5 years in some premiums. Society is showing some flexibility in the form of delayed corpuses and change in terms of the extra carpet area. So for us, I feel that now going ahead, probably we should be able to improve our ROC on the redevelopment portfolio.
My question was not that. My question was that not for existing portfolio, like societies which want to go for redevelopment because post-pandemic their choices have changed, like they want balcony or they want an extra home. So are old societies going more eager for going for redevelopment?
So I have answered that, Manoj. I said at the beginning itself, societies are not demanding anything in the form of...
No, not our portfolio, which are not in our portfolio, just old society just like that, who are not earlier thinking of redevelopment are coming, okay, let's do for new societies with the better amenities with post-pandemic.
Obviously, to the new societies are not demanding anything more than the market or the existing parameters of lifestyle amenities will depend on the size of the plot. So probably if the plots are in like half acre, 1 acre and the FSI consumption is on a higher side, they will be able to get maximum on the fitness center or some amenities on the rooftop. As well, if the projects are in the range of 3 to 5 acres, then obviously that's the common thing like a lifestyle amenities and all those things which we being a brand are providing to them, and they are also showing that in their tenders. So I think redevelopment is been linked to the tenders, and everything has been specifically maintained in the tender document. So no change post-pandemic, scenarios are same.
One of the competitors, Concall Godrej Properties, says that when they acquired a land in Bangalore, there was virtually no competition. So how we are seeing in BWA competition in terms of acquiring land, and they said their IR has considerably gone up in the new deals. Can you throw some color on that, what we are getting in the new BDAs?
So as I said on couple of answers earlier, I think on the BDA front, basically when we are going into a joint venture profit sharing or DM model, we are not calculating IRR because that can touch to a 2-digit, extreme 2-digit or probably a 3-digit number. We are focusing more on ROC because today I am getting projects at 10-15 crore deposit wherein we will be able to manage 90 to 100 crore sort of a profitability. So probably these kind of deals we are not evaluating in rather IRR model. We evaluate that on a per square feet basis, like being a developer, when we are doing 1 million square feet of construction and sales, then we should, and if the prices are in the range of 6,500-ish, then we should get at least 1,000 rupees per square feet as our margin. So we have a different parameters to measure different deals. Typically, if in the redevelopment portfolio we are going more on the ROC front, and as far as the JV, DMAs and profit sharing, we measure more on the per square feet basis, that whether we have been rewarded well compared to our overall effort. So these are the parameters which we are following. But if you want to answer in absolute IRR, then IRR can touch to a 3-digit number also when we are very asset light.
Thank you. The next question is from the line of Vinay Bateja as an individual analyst. Please go ahead.
I guess all my questions have been answered.
Thank you. The next question is from the line of Nikhil Upadhyay from Securities Investment Management. Please go ahead.
Yeah, hi. Good evening, sir. I have two questions. One is on the Bangalore piece. Hello, am I audible?
Yeah, very much.
Yeah.
Please continue.
So one is on the Bangalore piece. You said like as of now we are zero point 0.5 and probably in our idea of reaching 5 million, that would contribute around 1 million. But I'm not very clear on what is our approach and how we would be going about building that 1 million kind of a landscape for us. And the reason is because intuitively what I feel is that Bangalore is a much more organized kind of a market. So what is our thought process and how would we approach that market? That is one. Secondly, on a question which was already asked earlier, like the commentary from some of the earlier players who had organized the call was that the demand was very strong, and I was also expecting a very good offtake from your side in terms of our numbers. So is it like because we don't have any strong ready to move inventory, or is it like people are coming for inventory which is ready to move? That's why we are not seeing the similar kind of a sales velocity in this quarter, or what is the whole idea with which people are coming and what kind of products people are looking at?
Sure. So I think we can bifurcate your question in two parts. First, we'll touch to a Bangalore part, and then second, I'll give some thought process on the pre-sales front, why the pre-sales are not going to the next level and all. So coming back to Bangalore, if you see, currently we have unsold inventory to the tune of 0.59 million square feet, and all Raga project, Mirabilis project is completely out. So now from just two projects like Exente and Raga Phase 2, wherein we have some RTMI inventory, we are able to manage 2.5 lakh to 2.8 lakh square feet in last 2 financial years. I think what Bangalore, for us, in Bangalore we have to open 3-4 new projects, because each of the project like Exente, 18,000 per square feet on a month-on-month basis is possible. A project like we are selling 10 to 12,000 per square feet on a month-on-month basis. So we open 3 more projects, so I think we should be able to reach a 50-60,000 sort of a run rate, which is taking us to 7.5 lakh. So I think the next 1 year or probably 18 months, the idea is to acquire 3 new projects and launch, because each of the projects we are getting some velocity. It's all about less of inventory. There are only 3 projects ongoing. We have to open up, like in Pune we are 14-15 projects going on, and like in Bangalore we have only 3 projects, and there also we have a lower velocity because of the less footprint in last 2 decades, and brand recognition what we have in Pune vis-a-vis in Bangalore is different, because we haven't done much of the marketing campaigns, we haven't delivered like 18 million square feet sort of a portfolio. So Bangalore will take us some time, but definitely there is a revamped demand to our products, to our brand, which I have already highlighted, that how from last 10 years we were doing just 80K on a year-on-year basis. We have reached to 2.5 to 2.8 lakh square feet, which is a 3x growth on the pre-sales front. But going ahead, we want more projects so that we can show more growth at Bangalore. We are not competing with sort of a Shobha, Prestige, Brigade or other players. Our idea and our aim is to just acquire 1 million square feet over a period of next 2 to 3 years. And for the same, the business development efforts are going on. It's at the right time, we will hit couple of transactions, and then probably once we are opening new sort of a project, then we would be able to show some sort of a growth at the Bangalore region. Now,
sorry to interrupt, but just one follow-up here. Now, as you said, like when we are going for the project acquisition, and based on the commentary which you have mentioned, like you seem to be very bullish about Mumbai in terms of the redevelopment, where the ROCs could be very high. You have a very strong position in Pune. But when you are going into Bangalore and the kind of competition, do you see that the kind of deals or when you are sitting and discussing with the JDA partners or anyone, though the ROCs or the negotiating power which we have probably in Pune or probably now in Bangalore with societies we have, Bombay we have with societies, we have a similar bargaining power in Bangalore?
I think more or less same, but not exactly to the power what we are enjoying at Pune region. Definitely, because the brand presence at Pune versus Bangalore is different. So we may have to work on a moderate margins as far as the Bangalore region is concerned. We can't ask for a super abnormal margins or a very, very asset light. So we have to take some sort of investment and moderate margins at Bangalore. But slowly we can revamp that. So no doubt on that front, we cannot enjoy the same privilege what we have at Pune market. And coming back to your next question, I think as far as the pre-sales and overall sort of uptick, and you were talking about the inventory. As I said earlier, I think probably from last couple of quarters, it's more of a sustenance inventory, and we are selling that inventory from last 2 years. So probably if you see the ongoing and unsold inventory, what is lying as of 30th September 2020 is just 3.9 million. And if we have to target a 3 million inventory from 3.9, it's next to impossible, because customer wants choices. Customer wants different locations. So I think what we are lagging behind is the new launches, wherein we have the visibility now, and probably once we will be opening the new launches and new locations, then you will see there is a sharp uptick in the pre-sales, and we are gaining on the market share.
Okay. Okay, fine. Thanks a lot.
Thank you. We'll take the last question from the line of Rohit Balakrishnan from Riddhi Capital. Please go ahead.
Yeah, so just 2 questions. One, I think you mentioned about some of the partnerships or landing that you are planning to do. You're looking not from an IRR, because maybe the investment would be much lower, and you're looking at a per square feet level. So you said that, let's say, around 6,500 the take rate, if the selling rate is, then you look at about 1,000 rupees as profit. So when you're talking about this is what exactly? This is your operating, like EBITDA, or this is PBT, or this is your after tax profit? What is it exactly are you referring to? Just broadly, if you can share. That's the first question.
Sure.
Maybe after that I'll ask the second.
Sure. So I think when I talk about a per square feet margin on a DM project, I think if I am getting 900 rupees per square feet on a project of 7,000-ish as a selling price, so which is coming to me as a 10% sort of EBITDA. When we talk about the profit sharing, per se it looks like that we are at a 20% sort of EBITDA. And when we talk about the IRR, it looks on an extremely high side. So I just wanted to give you a further example. The whole idea to give a per square feet, because if 1 million square feet project, wherein we have to give just a 10 crore as a deposit, and if I am getting a 45 as a PBT, then that is a 4x from the ROC perspective, a 4 multiple. But as far as the margin per square feet is concerned, it is just a 400 rupees per square feet. So sometimes you have to do analysis from a variety of angles. So you have to also ensure that you are maintaining the EBITDA, ROC and IRR, but at the same time the per square feet margin has to be anything above 700-ish. So ranging for JDAs is typically 12 to 15% of top line. As far as the redevelopment and profit sharing, we are at 20-22% sort of EBITDAs. And when we go for a pure play outright model, then we expect that 28 to 32% sort of EBITDA and a 25 to 30% sort of IRR.
So just before I move to my second question, just as a follow-up, so as you sort of alluded to in your earlier commentary, that going forward for us to reach that kind of throughput of about 4 to 5 million square feet, a large part of it is dependent on the kind of BD we do. So, and some of these you mentioned what kind of margins one would make. So is it also fair to assume that, I mean, if we look at it from a P&L perspective, maybe the EBITDA margins could be lower than what they have been earlier for us? Is that a fair comment to make?
I think what we have to look from is a long-term perspective. Maybe couple of quarters you see that the EBITDA margin flowing 18 to 20%, and couple of projects you see the EBITDA margin flowing from 28 to 32%. But over a period of 4 years, I think we should be able to maintain the healthy EBITDA which we are doing from last 3-4 years, which is in the range of 25 to 27%. But yes, depends on the deals, depends on the pre-sale flowing from which region, under which structure. EBITDA would be a very fluctuating sort of a game going ahead, but there would be a significant improvement in the APR because Mumbai projects contributing, Pune historical projects wherein the APR is on a higher side, and we would always ensure that on the ROC front we are ahead of the curve. If you look at the peers, I think most of our peers are in the range of 3 to 7% ROC and ROE, while we are continuously maintaining 15.5% as an ROC and 11-12% sort of ROE. And I think on the scale front is what we are gearing up so that we can compete in all parameters while maintaining the integrity of the balance sheet and remaining low on the debt. So I think the differentiator what we are trying to play is remain low on the debt and still try to show growth and remain asset light and still try to build ROC and IRR. So these are our extreme parameters which we have set for us, and we are working hard on the same to deliver the same. Hopefully in next 2 to 3 years we can position ourselves as a realistic differentiator and create some sort of a very good value creation for all the stakeholders.
So the last question was that so you've stopped short of announcing the deals, but you seem very confident of announcing some business development deals. So these are under some CPs or I mean these are not yet closed, or anything can go wrong from there from that perspective, or everything is closed and you just are waiting for a few things?
So I think this time I was very confident on my talk because there are the term sheets are binding on the landowners and not on us, and obviously the substantial progress has been happened. We have started working this time across spectrum simultaneously. So probably the due diligence is going on, the drafts are going on, the designs are getting freezed, and we are trying to catch up easy from a definitive agreement to launch stage. So we are confident that we will be able to clock a 3 million square feet sort of business development in this financial year itself.
Got it. And from the, let's say, whenever you announce to the launch, one should take about 12 months, or can it be even protracted?
I think from acquisition, once we enter into a definitive agreement and then once we have announced the transaction, we will try to bring down the launch timeline to 6 to 9 months because the back-ended workings have already been started.
Got it. And sir, absolute last question. Sorry, I've said last couple of times. So if you see in the last 5 years, our ROC has ranged at between, has averaged around 14-15%, and the sector has been like really going through a very tough time. So can we sort of, I mean, typically you earn very low ROCs in down cycle, and then you have like a multiplier of that in an upcycle for a typical player. Now, given we have been fairly like protected in terms of our ROC also, and that's very commendable. But do you also see that when the cycle turns, we will be a bit like others may earn like very high ROCs, and because we've not suffered that much, so by the virtue of simple mean reversion, we will not also see very high fluctuation, and we'll hover around 20-22% only? Or do you see that this 15% ROC can actually see a step jump to, let's say, 30-35% also, which is very typical in a very cyclical sector like ours?
So I think it's a very futuristic sort of a question, and I'll try to give you the best of the answer. But as I said, the differentiator what we are trying to do is that low on the debt, low on doing transaction on asset light, and the moment, let's assume suppose tomorrow we are doing 3-4 DMAs. The DMA is directly adding to other income and adding to the PAT. So there is no sort of cost which is coming on the P&L. And if the PAT is expanding to the next level, and when you divide it by your net worth, you will see the ROC is ranging from 15 to 25. So that is very much possible with KOLTE PATIL developers. I think the reason being the way we are structuring the transaction, we are remaining light, but we are also ensuring the decent profitability. So it may possibly in next coming 3 to 4 years, the ROC can expand from 15 to 20 to 24 sort of a journey. But for the same, I think what we have to do is basically the projects which we are acquiring under revenue sharing and probably projects not under projects under profit sharing and DMA, those have to contribute well, because under revenue sharing obviously the EBITDAs will be low. That is not directly at improving our all financial parameters, but under profit sharing and DMA, definitely the ROC will go to the next level. So it all depends whether the maximum transactions are coming from revenue sharing or the transactions are coming from profit sharing and DMA. But if it's in the later part like profit sharing and DMA, definitely the ROC will go from 15 to 24 sort of journey.
Okay, got it. Thank you very much, sir, for answering all the questions so patiently. Appreciate it. All the very best and very happy Diwali to you.
Thank you. Same to you.
Thank you. Ladies and gentlemen, that will be the last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
Thank you once again for your interest and support. We will continue to stay engaged. Please be in touch with our investor relations team for any further details or discussions. Look forward to interacting with you next quarter. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of KOLTE Patil Developers, that concludes today's call. Thank you all for joining me. Now disconnect your lines.